Good afternoon, everyone. My name is Steve Meredith, and I want to welcome you to today's presentation entitled Financing Your Company's Physical Space, How to Maximize Low-Interest Economic Development Loans to Finance real estate transactions. My name is Steve Meredith. I am the Manager of Commercial Lending here at the Southwestern Pennsylvania Commission, and once again, I just want to welcome you to today's presentation and thank you for being here. Before we get into the meat of today's presentation, I do want to take a minute to talk to you a little bit about what SPC is as an organization. We wear a lot of different hats. We're a regional planning agency serving 10 counties in southwestern PA. We're a metropolitan planning organization. We're a local development district, and we are a core funded partner and fiscal agent for Southwestern PA's Partnership for Regional Economic Performance. So, as I said, that's a lot of government alphabet soup, a little bit, but from an economic development perspective, we are here to help small businesses start, grow, and prosper. So today's presentation is going to have a brief agenda. We're going to have a one-slide overview of SPC's traditional loan structure. That's just to give you an overview of where I'm coming from when I talk about financing physical spaces. We'll go over the questions to ask yourself before approaching a lending institution, the questions that you need to answer and really answer in the affirmative most of the time before you approach a lending institution. And then the meat of the presentation today is going to be talking about common issues and remedies when financing real estate transactions with economic development organizations like SPC. In my time here at SPC, I've seen different situations unfold that have prevented borrowers from being able to secure financing for a building. And really, this presentation is to help prospective borrowers avoid those potential pitfalls. And then obviously we'll have Q&A at the end. You can either type your questions into the chat box, or if you have a microphone and you would like to ask them live here, you can do that as well. So let's jump right in. SPC's traditional loan structure is somewhat like a mini public-private partnership with every loan that we do. We ask that our borrower bring 10% of their total project cost to the deal in equity. And then the remaining 90% of the total project cost is split between SPC and a private bank. What you end up getting are two separate loans. And because SPC's interest rates are so much lower than prime interest rates from the banks than the bank's interest rates, what you do is over the life of the loan, you end up saving money in interest. But that's the key reason why somebody would come to SPC and want to finance a building purchase with SPC and a private bank, as opposed to just going to the private bank for the entire loan amount, because you can save that money in interest over time because our interest rate on our portion of the loan is so low. So that's the basic SPC loan structure. Now we're going to talk a little bit about questions you need to ask yourself before you approach any lenders. First question is, do you have a location selected? And if so, have I communicated my interest to the seller? And keep in mind, this slide is by no means comprehensive, but these are good starter questions to ask. As I said, the first bullet, do you have a location selected and have you communicated your interest to the seller? It's best to approach a lender after you have at least located a space that you want to purchase. It's better for you to have an idea of the cost of the building before that initial conversation with the lender, because if you don't, it's not really any skin off the lender's nose, right? But what they're going to tell you is you really need to find a place, and you really need to talk to the seller about what the total project cost is before we can figure out whether we can support a loan to you. Second question, do you have a sales agreement with the seller in place? This is important because lenders will need to know the status of any sales agreements that you may or may not have in place, as well as whether or not the seller requires proof of financing before executing that sales agreement. That's one of the common pitfalls, and we'll talk about that a little bit later in the presentation, how to avoid that. But those two questions, do you have a sales agreement, and does your seller require proof of financing before they execute that sales agreement? Third question, this is a common question that all small business owners should definitely ask. Is the space move-in ready, or will they need to renovate prior to operation? Renovation costs will need to be included in the total project cost, okay? As the lender will need to perform what's known as an as-complete appraisal, including the cost of the renovations, in order to get an accurate depiction of the value of the building. The reason why this is because the bank and the economic development lender will take a lien or a mortgage on the purchase, on the building that you're going to purchase. And obviously the total value of that building is going to include the renovations after they are complete. The fifth bullet, if the space is the space being purchased, or is it being leased from a landlord? We'll talk about this a little bit later, but renovating a leased space is a bit tricky. And it takes some maneuvering from a collateral standpoint. So that last bullet is a little bit of a preview of coming attractions, I would say. Now, common issues and remedies in economic development financing. Again, these issues and remedies are issues that I have personal experience with. That's why I've included them in these slides. They're by no means comprehensive, but I think that with some of the remedies and with some of the strategies that I'm going to explore today, you can help avoid those pitfalls, those issues, and the economic development financing portion of this of the project can move forward a little bit smoother. The first issue is the issue of the chicken or egg problem. The reason why I call this the chicken and egg problem is because each side, quote unquote, each side thinks that the other side needs to complete their task first. When the seller wants proof of financing before executing a sales agreement, but the lender wants a finalized sales agreement before committing to financing. There are a couple of common remedies with this problem. The first is ask your seller if they will accept proof of loan approval from your lender prior to closing the loan. The reason why I put this first is when you take a loan from SPC, we cannot get you a commitment letter until our loan is fully approved. And our approval process has two prongs, okay? The first prong is on the third Wednesday of the month, and it's actually the Wednesday before the last Monday of the month, we have a loan review committee meeting. And then assuming the loan review committee meeting approves your loan, then the following Monday, our executive board would need to ratify that approval. Only upon that secondary ratification can we release a commitment letter. But what we do provide is we can provide a proof of approval from a loan review committee perspective, get you a copy of a resolution showing that our loan review committee has approved the loan. And if the seller will accept proof of loan approval from your lender prior to closing your loan, that's one way that you can remedy it. The second way to remedy it is a little bit, it's a little bit more common. It includes bridge financing through an EDO's private bank partner. So as I said a couple of slides ago, the way that SPC's loans are structured is we have 10% for the borrower, and then the remaining 90% is split between SPC and a private bank. In some cases, what you may need, if you have a seller that's eager to sell the property, eager to get the ink to the deal, so to speak, we can ask our private bank partner, hey, can you bridge SPC's portion of the loan? And essentially what that does is that gives you as the borrower all of the money you need up front to complete the purchase. And then when SPC's loan approval comes through, you basically take SPC's loan and you pay off the bank's bridge loan, and that's how you end up with the two loan structure that helps you save money and interest over the long period of time. Usually the banks that we deal with are relatively open to bridging for us, and certainly that's an option that you can sort of go forward with. The other reason that bridge financing is popular is depending on the program that we fund you out of. The approval process may include state approval, which can take sometimes a month and a half to 2 months in and of itself after our own approval process. So obviously that's not conducive to a small business borrower. So that's when bridge financing really comes in handy and really can help small businesses out. Just understand that, while it takes a little bit more patience with government financing, if you do have that patience and if you can couple that with bridge financing from the private bank partner, it can actually go relatively smoothly. So next issue we're going to talk about is the cost of renovation being unknown. Okay. So the space needs renovations prior to the business being operational. That's a common issue, right? Contractor estimates will contractor estimate-based renovation costs will need to be included in the total project cost, okay? And it's very, very important that you understand the key operative words in that statement are contractor estimate-based renovation costs. It's got to be contractor estimate-based. Renovation estimates can take time, especially in an environment that we find ourselves in. At the time of this recording, I am recording this for on-demand viewing, but at the time of this recording, we are in a state of inflation. Building materials have certainly risen in cost and things of that such nature. So it is, what I have found is that it is taking longer and longer for contractors to get back to borrowers with their estimate, their renovation estimate costs. So it behooves you, as one of the remedies, to engage your renovation contractor as early as possible to obtain those estimates. Number two goes hand in hand with this. Avoid estimating the cost of the renovation. Okay, avoid it at all costs. And third, if possible, fund the renovations using money outside of the loan proceeds. If your company is doing well enough to where you can pay for the renovations with money that you've saved from revenues, things of that such nature, I would highly recommend you do that. I would strongly, strongly, strongly recommend that you avoid at all costs estimating the cost of renovation. Here is why. I have a brief anecdote for you. I had a client who shall remain nameless to protect the innocent, right? The private bank that we were partnering with also shall remain nameless to protect the innocent. They approved a loan based on a borrower estimate, not a contractor-based estimate, okay? And they approved this loan without knowing the full contractor-based estimate cost, okay? What happened then was when their contractor came back and their contractor's estimate was $150,000 to $200,000 higher than the borrower's estimate, that left them with a shortfall in funding, okay? And it's very, very hard to go back to a bank and say, hey, I know you approved me this one loan, but can you extend me some additional credit because I have this shortfall because I misestimated the cost of my renovations. That's very, very hard to do from a collateral perspective, because again, renovations need to be included in the cost of in the total appraisal of the finalized building. And if they aren't accurate, then the appraisal is messed up, the value of the collateral is messed up, and it causes a massive headache for your banker. So what I would do is engage your renovation contractor early to obtain renovation estimates. Avoid estimating that cost at all costs. And again, the simplest way to move forward is if you have the money, and this seems like a no-brainer. This is not a revelatory statement, right? If you have the money to fund the renovation without a loan, do it that way. I think that's just the cleaner way to do it from an economic development perspective, okay? Okay. Here's another issue, prevailing wage requirements for renovation work, okay? Certain funding sources require a borrower's renovation contractors to pay prevailing wage to their laborers. I'll tell you a quick little aside. So there are three basic pots of money that SPC lends out of, okay, for typical economic development loans, which are buildings, land, machinery, equipment loans, okay? Two of the three pots of money are federally backed revolving loan funds, okay? One is backed by the U.S. Appalachian Regional Commission, and one is backed by the U.S. Economic Development Administration. Excuse me. When your project is utilizing federal funds, your borrower must be, your contractor must be able to pay what are known as Davis, they must be able to comply with Davis-Bacon prevailing wage requirements. Okay, which means that there is a wage that they need to pay their laborers. Okay, the paperwork can be cumbersome for the contractor without prevailing wage experience. I want to verify something. This is not something that the borrower needs to comply with. This is something that the borrower's contractor needs to comply with. Now, the simplest explanation or the simplest answer is to find a contractor with federal contract experience. If you find a contractor with federal contract experience who has the understanding of Davis-Bacon regulations and can afford to pay prevailing wages, then you're essentially out of the woods. But if you don't, here are some common remedies, okay? The EDO's bank partner can fund the renovation work, while the EDO funds the building purchase, the Economic Development Organization. That's what EDO stands for. That is an easy way to get around it, because the bank partner, if they're a private bank partner, they probably wouldn't have that Davis-Bacon prevailing wage requirement. Another way that you can remedy this is to ask the EDO to use a non-federally backed loan program. So that third loan program that we lend out of, that is a Commonwealth-backed loan program. That does not have the same Davis-Bacon requirements. But again, you still want to be careful that they don't have a state prevailing wage requirement that you might need to abide by. So just be wary of that as well. And then finally, I think the easiest way to make sure that everything is up on the up and up with this slide is to ensure that the contractor that you hire has experience meeting prevailing wage requirements. But the reason why I put this in the slide is, if you think about it, a slide before, you need to know your renovation costs before you go to your bank. Okay, but before you need to know your renovation costs, you should probably look into whether or not your contractor has federal contract experience. So again, chicken and egg. That's the whole theme of this sort of presentation. If you do things in the right order, if the first step is to find a contractor with federal experience, then the next step is to get their contractor estimates early before you reach out to your bank, things of that such nature. You can do things in the right order with the right steps to ensure that obtaining the financing is a smoother process, okay? Issue: the renovated space is being leased and not purchased, okay? Quite simply, if the space that is being purchased is being leased, it is hard to secure from a financing perspective. Think about it this way. If you are purchasing a building that you are going to renovate, the reason why that is easy to secure is because the bank and the Economic Development Organization are each going to take a mortgage on that property. And they can take that mortgage because you own the property, okay? But if a landlord owns the property, obviously at the end of the renovations, you are not going to own your space, okay? And the cleanest way, in my experience, the only way that leaseholder improvements can be financed is by offering a personal residence as collateral, okay? But I will caution you this, okay? It is easiest to offer that personal residence as collateral for those leaseholder improvements if and only if that personal residence is owned free and clear of any other liens, okay? The reason why I say that is, let's say for the sake of argument, you bought your personal residence from 3 years ago, and KeyBank has the mortgage on it, okay? And then you want to offer that residence, that personal residence, to collateralize or secure leaseholder improvements on your business. The bank that is financing the leaseholder improvements will have to take a subordinate lien behind KeyBank in order to secure that loan. And the value of that home, of your personal residence, in a second lien position, there may not be enough value in that home in a second lien position for your business bank to secure that renovation work, okay? Basically, what that ends up with is a collateral shortfall, okay? Where the value of the collateral does not match the value of the loan that the bank is giving, okay? So, and that is a very risky loan for the bank to do, and that is why they are a little bit hesitant to move forward with leaseholder improvements. Now, if you do own your personal residence free and clear, by all means, offer it up as collateral. That's probably the cleanest way to um, collateralize or secure the renovated space for the renovated leased space. But again, I do want to caution you that if you do have a personal mortgage, if you still are paying on your mortgage of your personal residence, it's going to get a little bit hairy, so to speak, when trying to secure that business loan. Because again, you don't own the property that you are going to be renovating, the landlord does, okay? Issue, business owner needs working capital. First of all, I want to make sure that everybody understands that this issue is more common than not. Most business owners that I talk to, especially startups, they come to me and they say, okay, Steve, I need financing for a building. I need to put some equipment inside of that building, and I need some working capital to pay some salaries, okay, and other startup costs, okay? So as part of our loan program, the terms on our loans are very attractive, in addition to the interest rates, right? The interest rates can be very, very low. They can be up to 4 points below prime, okay? Typically, a bank can sometimes lend a quarter to a half to maybe even a full point above prime. We can lend up to 4 points below prime, okay? That's why you end up saving money on the interest rate. But from a term perspective, on a building loan, we can offer up to a 15-year term. On an equipment loan, we can offer a 7 to 10 year term. And on a working capital loan, we can offer a 1 to 3 year term. Where it gets a little bit difficult for an EDO to finance working capital is because if you are essentially blending the assets that you are purchasing with EDO financing, let's say you're purchasing a building and taking some equipment. If you add working capital into that, we are going to have to blend the term of your loan. So let's say, for the sake of argument, that you're purchasing a building and you need working capital as well, okay? We can offer a 15-year term on the building loan. However, if you add in that working capital, we're going to blend that term. And since we can only give you a 1 to 3 year term on the working capital, you'll essentially end up with a 5-year term probably on that building loan, okay, because of that blended term. That's going to shoot your monthly payment way up, sky high, and it kind of defeats the purpose of economic development lending. Because the whole purpose of economic development lending is to give you a favorable interest rate, a favorable term, so that you can so that the monthly payment that you're paying is manageable, so that your business can still make money and still pay your loan over the years, okay? So one of the most common remedies that we have with this problem is that the EDO bank partner can provide a working capital line of credit, okay? So if, let's say that same example, if it's a building loan with some working capital, what we may do is we may say, okay, give us your 10% equity injection, and then we'll go to the bank and we'll say, hey, can you split the cost of the building with us, and can you extend the borrower a working capital line of credit? And a lot of times the banks that we work with are amenable to that. That's how we overcome that issue, okay? So moving to conclusion, as I said it in the last couple of slides here, EDOs exist to provide low-cost financing to small business borrowers with favorable terms, okay? As I said, our financing is meant to help you obtain the assets that you need to grow your business, but do so in a way that is not cost prohibitive to your future growth, to your future bottom line, okay? We are not trying to drop your business in the red. We're actually trying to, what we're actually trying to do is create jobs in the region, okay? Every single one of our loan programs has a job requirement, okay? And it basically says that you either must retain or create one job for every $75,000 borrowed. The skin that we have in the game, so to speak, is that we want to see you hire. We want to see you hire people because the way we develop an economy, the way we strengthen an economy is to add jobs to that economy. Okay, so that's our big goal here is jobs. With that in mind, the regulations must be followed, but as stated in this presentation, there needs to be some flexibility between the lender and the borrower to work through some of these issues, to remedy some of these issues with some of the strategies that we have mentioned in this slideshow today. But that essentially, ladies and gentlemen, is everything that I have. Here is my contact information, and I do want to plug two things. The first is our online loan application portal. We recently moved our loan application process for our internal loan funds online. And as part of that online loan application portal, we have a pre-application questionnaire. So if you go to the URL listed here, spcregion.portful.com/workflow, if you click that link and you go to that website, if you sign up for a free account, you can fill out our online loan application pre-application questionnaire. And essentially what that's going to do is that's going to help you understand whether or not you can meet our lending requirements as the borrower. And it will help us understand if you can provide the equity that's needed, if you have talked to a bank partner about this potential opportunity. And then essentially, if it appears that you are eligible for this funding, I will get an automated email saying that you have submitted a pre-application questionnaire, and I will reach out to you within 72 hours of receiving that questionnaire. And I can talk to you about the project and things of that such nature. And then finally, I urge anybody that participates in one of these or attends one of these webinars to connect with me on LinkedIn. I always love meeting new businesses, new business owners via that social network and facilitating questions or facilitating conversation that way. Speaking of questions, I had questions on my mind. If you have any questions at this point, you can put them in the chat function or put them in the Q&A box. Or if you have a microphone and you wish to unmute, feel free to do that as well. And I'd be happy to take questions live here too. I'll give everybody a minute. All right, well, hearing none, I thank you very much for you attending today. For those of you who are watching on demand, if you want to reach out to me with any questions, please feel free to do so at that contact information. Kyle Lamb is with us live. It's showing this PowerPoint is all I am seeing here. So I hope that you can see the PowerPoint. Yes, Kyle, I will be sharing the PowerPoint with anybody that was registered for today. So I will be sharing this PowerPoint with the registered attendees via email following this presentation. So thank you very much for asking that. For those of you who are watching on demand, please feel free to reach out to me via email. Please feel free to connect with me on LinkedIn or reach out via the online loan application portal, the pre-application questionnaire, and I would look forward to helping you out. All right, with nothing further, ladies and gentlemen, I will go ahead and wish you a good day.